one thing. That financial instrument, first of all, is understanding the theory itself, how it works. So, this is the theory. So we have Ipsas 28. Then we have Ipsas 29. Then we have Ipsas 30 and 41. I think you remember this one, isn't it? The way it is being arranged. But next I said you have to look on asset element in financial statements. So we have asset, we have liability, we have equity, and others. So today I will now explain how do we recognize financial instrument in Ipsas 29 and how we do for Ipsas 41 again, so that you can understand how you can position yourself as a preparer of financial statement when issues arise. We had a lot of discussion yesterday, but part of it was how the CAG is observing the audit report and what are the several issues to be observed during the queries. So, based on this as a summary, now I want to solve an example of how financial instrument can be reported in financial statements and how it will be responsible to. Remember yesterday, we had a thorough discussion on these rules. Do you remember? I said IS number 32 emergence for the Ipsas 28. But this was the story on how it works as from 2001, remember, when Ipsas started under Ipsas B to date. Okay? Again, the IS 39 resulted into Ipsas 29. Do you remember it? Again, we have development of FRS 7 to Ipsas 30. You see? And we started with equity instrument. That equity instrument is any contract that evidences a residual interest in the asset of an entity after deducting all liability. So equity is just asset minus what? Liability in accounting equation. But equity instrument in particular arises because we issue share, ordinary share. Am I clear? Okay. So in equity instrument, I said once an investor buys share from 0% to how many percent? 20. This is a demarcation where we have equity instrument. Above 20 to 50, we have what? Investment in associate. And more than that, there are different classifications you can go. So if this is an investor, somebody who is buying share, will have these accounting reports that he must debit equity investment against the bank itself. Remember this one? Again, the investee is a company which is selling share. So, in its book, there is ordinary share capital against the bank account. Do you see how it works? So, the share certificate is what we call financial instrument. Because this share certificate provides a right for the investor to receive dividends. Again, it provides the investee to pay dividend when the board of directors has approved it. So this is how it works on this kind of equity instrument. So a chain of contractual rights or obligation meets the definition of financial instruments. Now, if you issue a bond, we discussed, a bond, there must be also an investor. Corresponding, there must be an investee. So for a bond, for example, if BOT is selling a bond, therefore BOT is an investee. And if you buy a bond any personal, you are the investor. Now the BOT must issue a bond certificate indicating that you have paid for the bond. Such kind of bond certificate is what you call what? Financial instrument, because within a bond, we have financial asset and financial liability. In equity instrument, we have equity investment and share capital. Do you understand? In a bond is a debt instrument. We have financial liability and financial asset. Am I clear? Now let's see. This is how a BOT is publishing a public notice on how to sell different bonds. Do you see? I told you that we have treasurer bonds and what? Treasurer bills. So this is a treasurer bond issued. So these treasurer bonds, how many are we having these bonds? We have a 2-year bond, 5-year bond, 7-year bond, 10-year bond, 15-year bond, 20-year bond, and the 25-year bond, as well as 35-year bond. Those are the long-term financial instruments issued by the central bank in Tanzania. And these are the coupon rates. So if you buy a 20-year bond, you'll be subjected to 15%, 15.45% on the face value each year. To you, it is an income. To the bank, it is a cost. So the bond certificate indicates that the bank, BOT, must pay coupon income, and you as an investor, you must receive what? Coupon income. Therefore, financial instrument is a contract whereby two parties, one is receiving, the other is. That's how it works. So, let's see financial statements of BOT of 2018/19. The BOT also has its financial statements being issued in public. So once you go to the BOT website, you see them. So I've picked this one for a review. So this is asset. So the BOT reports what? Asset. Now on this asset, we have extra account. Do you see? We have cash and cash balances. We have holding on special right. A lot of things. You see them there. And they have what? Government securities. Now, once you go in details, this government securities is what we classify financial instruments. Do you understand from there? And then we have advance to governments. We have loan and receivable. Therefore, loan and receivable is what? Financial instrument. We have defined in Ipsas 29 that there are 4 classes of financial instrument. Number 1 is what? Loan and receivable. What? Financial instrument held for trading. And then we have available for sale financial instruments. Okay. Equity investment, do see. Meaning that even the BOT buys shares of other entity for trading. Therefore, it has equity investment. These inventories are not financial instruments. They are inventory, like stationaries and others. So at least I want you to understand when I say financial instrument, and once you read the financial statements, where to get understanding, where to get this information. So this is an example. Intangible assets are not financial instrument. They are debt in Ipsas 31. But yet the BOT is using a price. Am I clear? So I'm just trying to make it for you to understand. We'll see it. Let's go further. Liabilities. So we have in the balance sheet, we have liabilities and the asset. And remember, in the financial instrument, we have financial asset and the financial liability again. So in here, we have current circulation, we have deposit, we have governments, we have other deposit, we have item of settlements, foreign current financial liability. You see, foreign current financial liability. We have liquidity papers. We have provisional in Ipsas 19. We have retirement benefits, and then we have allocation of special drawing and others. This is how the balance sheet in BOT arises. Now let's see for some key issues for our discussion to be good and see others. Now let's see, you see the component of equity instrument. Do you see equity instrument? I said equity instrument arises if an investor buys share somewhere. Now, what is a component of equity instrument in the BOT statement? Number one, we have equity investment in Afric Bank. So, meaning the BOT bought share of Afric Bank. And on 19, it was this amount of billion. And on before that, it was 13. So you can see there is a gain, isn't it? And this gain may be because of price, or perhaps there is additional acquisition. Now, the next one is equity investment in Swift. It is how many? 1 billion. 0.42 from 1.45. So it is decreasing. Perhaps there is impairment or there is disposal. So actually, this is how you can see financial instrument. And from the notes, you can see the way equity investment in Africa's bank has been demarcated. He is telling us the story behind the acquisition of these shares. As I told you, in order to describe the disclosure requirement in Ipsas number 30, we must explain when did we buy those shares. How many shares were bought? And what was the price? So you can see this disclosure if they are sufficient to sanction the stage queries. Perhaps they are missing. We have par values, yes. See here. And we have these are ordinary shares in African banks. Now, how many shares? Does it explain? No. But he has disclosed the measurement basis and the share price per share. So this one, very important. So missing number of share to the notes and missing the risk associated with this bank. Is this African bank performing better on forward looking? So actually, this is how African banks and BOT statements has been described. And also Swiss Bank, investment in Swift. Also, this is the description. You can see some of the information very useful. Do we see number of shares? Somewhere? No number of shares. But we see the price per share. Actually, shortcomings are there, but we have to adhere to the standards. Okay, so we have seen some of these examples. Let's see the government securities. Now, government securities, number one, is say stocks. The term stocks means what? They must be somewhere. Number two, treasury bills. I told you. We have treasury bills and treasury bonds. And he said, these are amortized. And they are held at amortized cost, meaning these are debts. Because you can't hold equity at amortized cost. So we have special treasury bonds. We have seen, we have treasury bills and treasury bonds. Again, we have treasury EPA stock. The term EPA means external payment arrears. The term escrow, it has other meaning in banking settlement. Although we have the fraud on the escrow account. Again, we have fraud on EPA account. So let us get started. Okay. Let's me go and see. These are now papers to be resolved with your example, open paper with 20 mark. Solve this paper. Of course, I have solved it. But now, I can't go through this paper. This relates to bonds. So I want to explain first on equity and see how we can grow to another point so that you understand it accordingly. Now let me go to this information. Make sure you have a calculator with you and you are open minds, so that once I give you some examples here, you should be very much aware, because it may arise in your examination. Okay? First of all, I will start with Ipsas number 29, and I want to describe the component of equity as treated in Ipsas number 29 and also as treated in Ipsas 41. Am I clear? Okay. So, equity, I'll now talk to equity instrument. At this point, I want you to get started, and you must be aware which position are you talking. We have investors' books, and we have investee books. For equity, we are not much interested with investee book. You see, we are interested with investors' books, because in investee book we have share capital, and the entity is using that money to run a company. Therefore, once you buy a share capital, its measurements will stay on the books as equity share capital. Nothing will go through. Okay? Now, reference, this is Ipsas 29. Remember, acquisition is ranging from 0% to how many? 20. In this capacity, I want to simplify the problem. So, in Ipsas 29, we have 3 classes of financial instrument. You'll see. So, we have financial instrument ready for trading. This is class 1. Financial instrument ready for what? Trading. These will include shares bought for trading. Number 2, we have financial instrument held to where? Maturity. So this one will include the treasury bonds. Treasury bonds. You see, any bond which is bought and held to maturity in Ipsas 29. Number 3, we have loans and what? Receivable. Remember, this financial instrument we have in our books. We have receivables. But remember, statutory receivable are out of scope. Prepayments are out of scope of financial instrument. So, but other receivable will be within the scope. Number 4, we have available for sale financial instrument. So today I will describe the first component only in 2 standards. The second component we can do in another period because of time constraint and etc. way it works. So what I want to describe, if we bought share as an investor in Ipsas 29, we have only one option, that all shares must be treated as what? Financial instrument held through surplus or deficit, meaning ready for trading. Am I clear? So, let us take an example and make it more comfortable. This is example number 1. Am I clear from there? Example number 1. So, Example 1. Can you cite example of public sector in Tanzania which have a higher transaction on equity instrument? Can you cite one of it? One of it is PSSF. PSSF always receives contribution from public servant. And they use that contribution to buy other investment so that on retirement, they can be able to pay the retirement benefit. So, PSSF, as a public sector in Tanzania, bought 10,000 shares from CRDB, and the following has been produced. So PSSF is an investor, has been produced. I repeat, in this ground, PSSF is what? An investor. And CRDB is an investee. Number 1. At acquisition date, what was reviewed? And I want to make you comfortable on this problem. Number 1, number of share boards. Amount to what? 10,000 ordinary share. You see, price. ZDS. ZDS 5,000 per share. So the market price at acquisition date was 5,000. It's an example. Number 2, transaction cost. Amount ZDS just take right here to make, yes, ZDS 2 million. Right? Now, date of acquisition. Date of acquisition. It was on 1st July 2020. Number 2. Let's see. Number 2. Stock market price. Trading results at DC. Remember, if shares are not listed, I repeat, if shares are not listed, we can't see their trading results. You get the point? And therefore, they are OTC. Therefore, we can't apply Ipsas to it and also FRS to it. FRS applies to listed company so that you can have some trading result from stock market. So if companies are not listed, in actual fact, even you can't apply FRS or Ipsas in this ground. So Ipsas and FRS are made for listed company in this ground. Let's see trading results. So we have date. Again, you have price per share. Price per share. We have dates and then price per share. Let's see if it is 30s. June 2021. You see, shares were bought when? 1st July 2020, isn't it? Therefore, after 1 year, remember, the issue to be reported in financial statements is said that in every financial statement at reporting date, a public sector must observe the price of financial instrument in stock market and report in financial statements. That is a requirement in Ipsas number 30. So if shares are trading at this 6500 per share, again on 30th June 2022, shares are trading at 1,000 per share. That is a presumption, meaning the shares are growing. There is a gain in price from one point to another, isn't it? Now, required. And this is very professional. And this is very proportional. Number 1A, discuss the accounting treatment of financial instrument in 2021 and 2022. Very important. Produce the disclosure requirement. The disclosure requirement as per Ipsas number 30. I repeat, it's not possible to go through financial instrument without cutting across through all standard. Remember, recognition and measurement is within Ipsas what? 2029. But presentation, it is Ipsas 28. Disclosure is Ipsas 30. So in a financial instrument, that is the problem. So you can't answer the problem without cutting across through all the standards. Now let's see the solution itself. In this problem, it must specify here. It must specify here that PSCF bought 20,000 shares from CRB for trading, so that we classify it for trading. Although Ipsas 29 has no option if shares are not bought for trading, because it was a rule-based. So, in any circumstance, from now in Ipsas 41, the examiner must explain what was the purpose of buying those shares. So, presumption will assume that this share we bought for what? Trading. So that we apply class 1 financial instrument. So, assumption here, shares are bought for what? Trading, and thus classified as held for trading in Ipsas what? 29. So this is class 1 financial instrument. So we are going to use the fair value recognition in balance sheet. use what? Fair value on subsequence. Measurement. Am I clear? Now, working number 1. Initial recognition. Initial recognition. PSSF. So, we are saying in the books of what? Yes, not CRDB. The books of investor. And that's why I told you I want to make this very much clear and with demarcation. I want you to listen carefully because you may be missing such chances of listening. Okay. Now let us see in the books of PSSF. And this is initial recognition. So PSSF has bought 10,000 shares. Initially, what we are saying, the PSSF buy and pay for it. So acquisition of share. What are the journal entry? Because in the books of PSSF, they are going to have equity investment against the bank account. So you debit and credit. So you debit equity. Equity what? Instrument or equity investment against the bank. Now at what value? So you bought 10,000 share at a price of 500. Now compute it, please. What's that? It is 50 million, isn't it? Good. 50 million. So these are the journal entry. Now, what happened to a transaction cost? Who can tell me? These shares are bought for what? Trading. Therefore, the transaction cost is going to be expensed in the financial statement because shares were bought for trading. So you debit and credit. You credit the bank, and then there is admin cost on acquisition of share. How much? It is 2 million. So this one is going to be in where? Statement of where? Performance. Now, where do we locate equity investment? It is in statement of balance sheet. That is initially. Do you get me? Okay, let's see. Subsequent measurement. So as at 30th June 2021, what happened? And as at 30th June 2022, what happened? Am I clear? Do you understand what I'm saying? So in order to solve this question, you must create a line by line assumption that we had this transaction initially, year not, subsequent, year 1. That's where we prepare financial statement, isn't it? Again, we have comparative in year 2. So putting the dates, this is 30th June 2021, and this is 30th June 2022. Do you get me? What is being portrayed here, and very simple, you should not panic so far. So you bought 10,000 shares here. You see? And yet, on year 1, you have not sold any shares, so you had also 10,000 shares. And on year 2, in year 2 also, you had 10,000 shares. Do you get me? What was the price initially when shares were bought? You have to disclose. P1 is 5,000, and P2, what this one? 6,500. And P3, what this one? 8. Do you see? Because these shares are measured at fair value at reporting date. Therefore, using fair value, you have fair value note. You have fair value note initially. What was the cost? Fair value note, and then fair value 1, and then fair value 2. You multiply these numbers. You multiply these numbers. You multiply these numbers to produce fair values. So fair value 1 is 50 million. Do you get it? Fair value 2 is 65 million. And fair value 3, it is 80 million. Do you get me? Do you understand? Now, there is a gain in fair value. Now, in Ipsas number 30, it says, you must disclose whether there is a gain or loss on handling those shares as at reporting date, after producing the price per share in each date. So we have the gain here. We have the gain. How much is that? So there is a gain in year 1, which is 15 million. And gain in year 2 is how much? What? Again 15. Is it 15 or 25? Also 15. Okay. No problem. Now, let us see the extract of financial statements so far. I will now produce the following so that you understand. First of all, the statement of financial position and in comparative form. I repeat, the statement of financial position in comparative form. So we have year 30th June 2021 and year 30th June 2022. Am I clear? In particular. So in balance sheet, what are we supposed to report in respect of financial instruments? These equity investments are non-current asset. I repeat, these equity investments are what? Non-current asset. So, what is to be written in current asset? So, in respect of shares. Now, if you buy share, what are you expecting to receive as cash? Is cash dividend. Do you get the point? It is what? Cash dividends. So, an auditor will be very interested to see the following. Number 1, cash dividend. Number 2, dividend receivable. Perhaps a public sector has declared dividend but not paid them all. So these two transactions for auditing purpose, very important. So this is an asset here, cash, and also this is an asset here, cash. But this problem does not explain anything about this dividend. But for learning purpose, you must be able to understand how to audit financial statements when somebody has bought financial instrument in this category. Am I clear? Number 2, you have now the non-current asset. So you have the PPE, which is not in existence, and you have equity investment. Now, this is our interest in this problem. How much is this? At reporting date in 2020, it was observed that we have 65 million equity investment. And currently, in 2022, we had how many? 80. So remember, we report equity investment at fair value. That is an accounting policy. So disclosure notes, you must state the accounting policy which has been used to account for the equity investment in your notes. That shares are reported at fair value, and from the information from the Dar es Salaam Stock Exchange, the price per share was this one. Am I clear? So in balance sheet, we have done. There is no further determination on this. Now we go for statement of financial performance in comparative year again. Of financial performance. So we have also 2 years, 30 June 2021. Again, 30 June 2022. So, how is the statement of performance? We have revenue from exchange transaction. Revenue from exchange, and we have revenue from non-exchange collapse. That is very important. So we'll be having some figures here. Okay. Now, what to disclose as revenue from exchange? It is dividend from share. Dividend. The amount of dividend, whether paid or not paid, on accrual basis. So, dividend. Dividend revenue in this year and also in this year. But for this problem, we have no information for dividend, as I said. So, total revenue will be here, meaning you sum the two. This is Ipsas 23, and this is Ipsas number 9. Am I clear? Now, there is a problem here. Don't write anything there. There is a problem. There is a problem. We have gain on share. Now, gain on fair value, is it a revenue? Yes, it is a revenue. Therefore, somewhere, and this revenue is arising from exchange transaction. So I will put a demarcation. That's why if you read financial statements in respect to the treasurer, there is a gain in fair value of equity investment. So gain. Anywhere, fair value. We have 15 million here, and also we have 15 million here. Let me show you the financial statement from treasurer. How did they disclose the gain from different financial instruments in the country? So I have them here. And this statement has been positioned in the website of a treasurer, but very few people are observing these financial statements because of some cases notably known by them. But I will now show you how to, as an example, financial statement. Yes. Do you see them? Do you see? You don't see them. Oh. This is for. No, this is not for treasure. This is not for treasure. Wait. It's not for treasure. What you worry? You will see them. I'm here to assist you so that you become expert. Perhaps sometimes you can be working with treasurer on some case. So this is for treasurer now. You can see them. Dr. Philip Mpango at that time. So this financial statement has been disclosed through the website of the treasurer. So I take them there. So it's not confidential to others. So if you want to see them, go to the website. It is there being discussed. Dr. Galugendo was the one who signed them. So you should not worry. Let us me show you where are the components of fair value from those shares. Because once you understand them, I'm sure you'll be able to understand why am I insisting this for you, especially on this standard. And that's why the treasurer has issued a circular to all public sector in Tanzania to comply with Ipsas 41 particularly, so that they can be able to account for these shares. You see, this is tax revenue. I want the performance so far. Receipts, very social benefits, cash equivalents, gross financial statement. We better concentrate. Yes. Do you see this one? This is the statement of financial what? So the first component is what? Tax revenue. The other one? You must read financial statements. Do you see? You are not reading. And what this one? Social contribution. This might be rooted from these pension funds. So we have external assistance, grant and aid, service revenue, fine penalties, including those from police. We have other revenue, debt forgiveness. You remember? Debt forgiveness is an income, meaning the World Bank may forgive debts for Tanzanian government. And then you have what? Read there. Fair value gain on what? Equity investment. That's what I'm insisting. Fair value gain on equity investment. We have fair value gain on investment property in Ipsas 16. Which means that this building are being reported using fair value rather than cost model. Actually, this one may conflict the accounting policy adopted by the government. If we have adapted the cost model, why using fair value model in investment property and having this gain? So they say query, sometimes you can query, because I've seen there are some public corporation are departing from the government. Exactly. Now, is it true that we have adapted the cost model in investment property? Do we have any guideline from it? Okay, sir. Again, fair value gain from where? Biological asset. We have fair value gain in financial asset. We have fair value gain in marketable securities. We have gain in foreign currency transaction in Ipsas number 4. Am I clear? It's up to you. So now what I'm insisting here is this gain. This gain here. Do you see? 15 million in last year and in the current year. Am I clear? Now, we have operating expenses here. Expenses. We have other expenses, the case may be. But then you have transaction cost, which was 2 million. Accordingly, you can now produce the surplus or deficit. Am I clear? Am I clear? Let's see the component of cash flow. Statement, yes. Yeah. Tell me. You are writing. Okay. Okay. So we have surplus deficit. So actually, if somebody is trying to perform an internal audit on a share or on a financial instrument, these are the key issues. Now, what is the extract of cash flow? Cash flow statements. Cash flow statements, it has 3 activities. Number 1, operating activities. Number 2, investing activities. Number 3, it is financing activity. So this is how it works. Now, buying shares, investing in share, is it investing activity, financing activity, operating activity? So changing the cash, and then opening cash against closing cash. So yes, what is this? Is it investing or investment in it? If you buy shares, that investing. So you write cash possession of share. Let's see. Put it here. Now, if during the year you receive what? Dividend. So dividend received. It is from where? So for example, here you paid how many? 50 million cash out. Now, if you receive dividend income in cash, then that is cash inflow dividend. So, cash dividend, that is positive. The net cash flow is the difference. But we have not been given the dividend income. That is an extract from cash flow. Any problem? Now, disclosure notes, part B. Part B, what to disclose? Disclosure note in respect of those shares. So you have to mention at each reporting date issues to be disclosed. Number one, you have to disclose the number of share bought. You see, you have to disclose the price at acquisition date. Again, you have to disclose any gain. Okay. On fair value. You have to disclose the price of share at reporting date. Price of share at reporting date. You have to disclose any risk associated with those shares in forward-looking. Any risk. So, report risk associated with shares. So you must be able to forecast. So if you had a share in perhaps, which bank is collapsing so far? Yes? Which bank is collapsing in Tanzania? Or are strong? For example, you hold a share in Ipsas and somebody has announced for liquidation. If you hold a share for FBM Bank and BOT has issued a statement for liquidation, therefore you have to disclose the risk associated with having those shares in actual fact. So those are the very small. And this is in Ipsas number. Remember, we use Ipsas number 30. Now, I start presenting element in financial statement. We use Ipsas number 28. You see, computing figures on recognizing asset or ability in books of account. We use Ipsas number 29. Disclosing in the notes and all other requirement, it is in line with the Ipsas number. Good news. That's how it works. So for equity instrument, I'm sure you become an expert on how to advise others to comply with these standards. Any question? So let's see equity. What is in equity instrument in Ipsas number 41. I said in this ground there are two options. You can held share for trading or for strategic. When you hold share for trading, remember, its gain or loss is through statement of performance. If you held share for strategic reason, its gain must be accounted in the statement of net asset. So the amendment has been added on accounting for shares held for strategic reasons. This one here is the same as in Ipsas, same as Ipsas 29. But this one specifically, it has been added for Ipsas 41. Am I clear? Now let us have a problem on how to handle these two, so that you can know the difference. So let's see example number 2. What happened when an investor bought share for strategic reasons? Okay, Kagoda a public sector in Tanzania, public sector bought 100,000 share from Tigo for strategic reasons. Now Kagoda has bought share from Tigo, but the reason being strategic reasons. Number 2, details at acquisition date. Details at acquisition date. Number of share. It's 100 shares. And the price per share is S45 per share. Transaction cost. So the S 5 million. So same problem, but now it is headed for what? Strategic reasons. Trading results. Item number 2, trading results. Any problem? Yes, we want to see some figures, please. Take them. So details, he bought 100,000 shares at a price of 4,500 and the transaction cost is 5 million. That is how it works. Now, this problem cannot be solved using Ipsas 29 simply because Ipsas 29 has no option when an investor has bought shares for strategic reasons. So this one must go to Ipsas 41. Trading results. That is date of acquisition. I've not given you date of acquisition. Date of acquisition, the same date. But trading results, now I'm talking of June 2020. 1 year after, isn't it? This is 19, might be 19, sorry. 19, so 2020 and 30, June 20. Is it clear? Yes. Now, we have to the S. Seven, and then to the S850 share. Now what is saying? Required discuss the what? Accounting treatment. Now let's go. A problem is, how do we account for initial recognition when shares are bought for strategic reasons? That's a very key issue. Very serious. Because we don't have shares in the statement of performance, but rather in the statement of net asset. So, solution. Ipsas 41 will prevail. And the business model, shares has been held forward. Strategic reasons. So gain through where? Statement of net asset. These are the policy. Gain should not move to performance because the shares are not ready for trading. Therefore, now what are the key issues? Initial recognition. Work number 1. Initial recognition. That is now very important. Number 1, you debit. What do you debit there? There is equity investment. Then you credit 2 items. You credit 2 items. That's where you need to understand. Number 1, there is transaction cost. How many? 5 million. And then acquisition of share. How many this one? Remember, you bought how many shares? Yes, you multiply by 4,500. How much is that? You just multiply. 4 is 450 million. Isn't it? So, 450 million. In total, this one here. So, equity investment must capitalize the transaction cost. That is very important when shares are bought for strategic reason. Remember, capitalize
What is that 2%?
transaction cost.
No, the 2,000.
This term of 2. You add 2 to get the total cost in getting the investment. So in having an investment in equity, you must pay transaction cost and you must pay acquisition of share at a nominal value. So we capitalize transaction cost into equity investment. But the previous one, we didn't capitalize the transaction cost because Ipsas 29 does not permit an option of having strategic 50? 455. 450. This one here. Yes. 400. Okay. It is 450,000. 450. This one here. Oh, so it was actually 500. And then 455. So 455. Isn't it? Yes. Now we have done. So remember, this must be capitalized. And on subsequent, it is easy to go. On subsequent, it is easy to go. You draw a line and you put here note. You have here 1. You have here 2. So you keep on trending. Number of shares in your note. This is the value. This is the shares. This is shares. Price 1, 450. Price 2, how much? And price 3, how much? This is 7. And this is 800. And 500. Now, find out the fair value. Not fair value 2, fair value 3. Compute them. It is easy to go through. And you can do it. This is 85 million, 7 million, and this is 455 million. So we have gain. Gain number 1, how much? And gain number 2, how much? The difference. This is 150, isn't it? How about this one here? This is gain 2. Yes, how about the difference there? Yes? 245 million. This is gain 1. So these two gain, actually the position is easy because you report them at these values, isn't it? So extract balance sheet is easy. Do you see the figures? Do you see the figures? How do I get them? So you can prepare extract, isn't it? It's possible extract can be there. Let me put balance sheet extract so far. In the balance sheet, extract financial statements. Yes.
The fair value of the amount.
Yes.
It includes the transaction cost.
Yes. That's why I say initially you capitalize them because you can't expense. And therefore, this transaction cost cannot be reported as an expense in performance. Gain 1. Yes. Do you see the difference? Is it a problem? Okay. So let us go. So for equity investment, remember the current asset, we have those information, but non-current asset, we have what? Equity investment. So we have 7 million and what? 85 million. Off you go. That is equity investment in balance sheet. Am I clear? Performance, nothing, because the shares are not held for trading. Do you get me? Nothing there. But remember, if the company pays dividend, a revenue is collected in performance. But the gain of these shares can't be reported in the statement of performance. So the statement of performance will not report any gain from this share. But it can report the revenue from dividend collected if the company pays dividend, isn't it? But from its essence, it is headed for strategic reason. So if the board don't pay dividend to him, it's not a problem because he's there strategically. Now let's see statement of net asset. Statement of net asset. We have the following components in net asset. Number 1, taxpayer. Number 2, accumulated what? Surplus. Am I clear? Accumulated surplus from the performance itself. Number 3, you have to add gain in equity investment as a line item separate from, this is a reserve when shares are headed for strategic reasons. So then you have total here. So you have 3 elements in statement of net asset. So in 30th June 2020, taxpayers and this one, and gain is 2, how much?
Gain 245.
245. Again in 30th June 2021, taxpayers accumulated and gain is, that is outward. So the gain from share in Ipsas 41, when shares are held for strategic reason, never be stated in the statement of performance. You have to go to the statement of net asset or equity. Disclosure notes, the same. You have to show number of shares, the risk associated, the price at each reporting date, and all other cases.
So what is that last
Total. This is
total of what?
total of all these.
Volume.
Taxpayers plus accumulated surplus plus this gain from strategic shares. So remember, once you had shares for strategic purpose, you must open a reserve, a separate reserve, which will be recording the gain on those shares. It's the same if you have opted to use the evaluation model in Ipsas 17. You must open a separate reserve called what? Evaluation surplus reserve. Any problem? Any problem to that? So we have seen treatment of share, and we have seen the amendment of Ipsas 29 to where? 41. When accounting for share. So remember, the government owns shares in Tanzania. And they can be owning some shares for strategic reason and not for trading. So for a very long time, no dividend is received, but they still hold those shares. So I think we understand. So let me stop from here and get started. God bless you.